And welcome to the Monday morning market wrap. Please excuse me while I change the microphone input. And there we are, back to this fabulous Yeti microphone. Huge couple of days. Non-farm payrolls, 271,000, the biggest since December last year, fourth biggest over the last couple of years, and really does drag that average up and almost guarantees a Fed tightening at the December meeting. It's going to be really interesting over the next few weeks as the Fed continues to double down on the fact that they're going to ease. You saw Evans and Williams both say that it's better to get moving than have to ramp things up later on. And I think the key for me is we're starting to see this wages inflation. And there was a fellow on Twitter kept bleeding things about, I don't mean that rudely, but he kept tweeting things about, wages inflation doesn't cause, too much actual inflation and all that kind of stuff. That's not really the point. The key here is that US wages are starting to rise. Jobs are still coming through at a solid rate. And that tells you, as I've said 1,000 times, that zero interest rates are entirely inconsistent, utterly inconsistent with where the state of the US economy is now. And what that means is rates need to rise. The Fed needs to get rates back to 1 or 1.5% as soon as possible, so that if there is another slowdown, or when the next slowdown comes through, they can drop rates again. Otherwise, they're in this endlessly terrible Japanese scenario. That's what they're going to do. They're going to raise in December. They're going to say we're not going to ramp them up every month or every meeting for the next year or so, but they will. I'm pretty sure say that things are looking better for the US economy on both the inflation and on the jobs front. On the other side of the coin, of course, we got Chinese trade data over the weekend. Now, Chinese trade data is important for a number of reasons. It's kind of a health check on the global economy. It's definitely a health check on the Chinese economy. But I also think it's a health check on places like Germany and that kind of thing. So if we have a look specifically at what we saw last night, over the weekend, I should say, was that exports fell 6.9% against the market's expected fall of 3%. So that's a big miss. And we saw that imports fell, 18.8% against a 16-point expectation. You're not really supposed to do that on camera, but I apologise. I stood in the rain for 5 hours timekeeping at a swimming carnival yesterday, and I'm a bit snuffly today, so my apologies. Anyway, so that's not good. Gives you big trade surplus, fantastic, but it speaks of a slow Chinese economy. It speaks of slow customer economies. It speaks of a weak global economy. Now, back in September, we think back, that was one of the reasons that the Fed said that they weren't going to hike rates. They were worried about conditions abroad. Now, have those conditions really improved? Some people like Morgan Stanley's head of global research reckons they have, and that 2016 is going to be better. And you'd guess it with all the stimulus in China's economy and that sort of thing, that things will get better in 2016. So I'm not a pessimist by any stretch of the imagination. But what that data does show is it does show that China and the rest of the world is still struggling a little bit. Why else would people be talking about rate cuts in Australia? Now, that means that Chinese data on CPI and PPI later this week is going to be huge. PPI deflation's been rampant in China, and the CPI is slowing down. So let's keep an eye on that. But the point I wanted to make about what this McLeish fellow, and let me just bring up my morning report from Business Insider. Don't forget, I do a morning report now at AxiTrader. You can go over there and have a link on my own website, gregmckenna.com.au. It's the first one today for me over at Axi. So I don't actually know. They've just asked me a question. Just about to pull the trigger. Reason you could. Okay, they're about to publish that. But and it's a different report. It's a much more trader focused. I know that sounds strange because the one at BI is 20 seconds for traders, but one overview of what traders will be looking at. One's more specific about the things I'm looking at as a trader. Subtly different voices, but both worth reading. Anyway, the thing is that, and I'll get this McLeish guy's name because it's a really important point he made. Just excuse me one sec. Neil McLeish, he's the Global Director of Macro Research at Morgan Stanley. So my apologies to Neil for getting his title. The point he made, and I think it's a good point, is that the Fed is tightening. But if we think about in a world where, big ships with 3 masts were what drove global trade, you could almost think of each economy, and perhaps in many ways each regional economy, as closed economies. Yeah, sure, there was linkages with trade with other regions or other countries, but largely they existed in their own little world. Fast forward to 2015, you don't really have that many closed economies. There will be, whereas openness was the exception, now closedness is the exception. Pardon me. And if we think about the global economy, it's a big open economy. Stuff can get everywhere in 2 minutes flat. I can order something from Amazon and it can be here in a heartbeat. I can order something from Microsoft and Toll lost it. So I've been waiting 2 weeks for my Surface Book, but that's another story. Anyway, the point says in this global world, the Fed can tighten because there's still lots of monetary accommodation everywhere else. The ECB, Wiedemann, and one of his other mates from the ECB said the bias, they're in a very different position to the Fed and that the bias is for easings. The Bank of England is on hold at the moment, likely to rise in 2016, but still accommodative there. The Bank of Japan needs to be accommodative. China can drop the rate again and get trillions of yuan into the economy just by letting loose that reserve rate ratio again. So there's lots of monetary accommodation, and Morgan Stanley firmly believe that the Fed can move without impacting too much. For me, though, what the Fed's move does is it pressures bond rates. Friday night, we had the 2-year note rise to 0.95%. That's the highest since 2011, and the close at 0.89 was still the highest close since 2011. Now, you might say 0.89, that's still 2/5 of nothing, but even German 2-year rates rose. Sure, they went from negative a lot to negative not as much, but they rose. Australian 2 years rose. 2-year rates rose around the world. Now, why is that important? If the 2-year note rate in the States goes up through 2%, all hell could break loose on bonds. Already, the 10-year bond in the US is at 2.33%, and you can really get. And what's going to happen? You get a discount rate impact on stocks. So, but for the moment, S&P, the one I watch, is still at 2100. It hasn't taken out 2135. If you think of it just as a plain old range, it's still in that range. So that might be a good time to have a look at a few charts. Just quickly. This morning, the Aussies opened at a little bit lower at 70.27 on that Chinese data, but it's still looking relatively okay. And I'll show you why in a sec. So let's do a quick around the grounds for the charts that I'm looking at this morning, and I'll get rid of that. So you can see that if you remember last week, we had a test. It's failed. It's come down. It's now at the bottom of. And these are my AxiTrader charts. You won't notice a discernible difference. I'm trying to whether I should go back to the default black Axi charts or stick with these ones that I normally use. So any feedback is welcome, whether you'd rather see black charts or these charts. So what we've got here is we've got the Aussie dollar both at the bottom of this downtrend, but also slightly outside the Bollinger Bands. Now, you know what that means, folks? Outside the Bollinger Bands for me means consolidation or rally. So I'd rather be a buyer down here, 20 points either side of 72, than a seller just at the moment. If I have a look at the 4-hour charts, you could see it get down to this 70-cent region, and maybe you'll see a rally there. So we're still outside the bollies, but we'll wait and see. It depends how Asia opens up and how Chinese markets and everybody else copes. But let's have a look at the S&P on a daily basis. So lots of long tails, lots of market indecision. Let me just blow that up so you can get a better picture of it. lots of market indecision about what's going on here. Just holding that 2100 level, 2099 close. Support's coming up to 2070. So from my point of view, I still think we're going to get back to test my support. Fast moving average, don't forget, folks. That's my general level of support. Overall, on a daily basis, it's a bull trend. But at some point, we do get these retests towards. So I'm still expecting, a test into the 70s at some point, and then we'll see how it goes. But it would have to break that, and then even have to break 2040 before I'd get overly bearish. For the moment, you've got the market, trying to be positive about what jobs, what the increase in jobs means. Now, Sterling, we talked about Sterling last week. I said if what was it? Something like that. I said if that broke, then all hell breaks loose. That's what we've seen. So you can see that it's now down at 150.50. Slightly incongruous, I guess, given that Mark Carney said rates are going to rise next year, but he's been saying that for a while. What Mark Carney says and what Mark Carney does are often just two different things at the moment anyway, or since he's moved across to the Bank of England. I think he's got a few more strong-willed people who know what they're doing at that bank than he did at the Bank of Canada. Did I say that out loud? Anyway, so that's Sterling. I'm expecting to see some sort of support in the next 50 points. On a longer-term basis, I'm guessing Sterling is going to head low, but just not today, I wouldn't think. Dollar yen's another important one. It's a huge day. I could talk for half an hour. It's a big break here. It's slightly overdone. It's a long way from the support. The support's going to need to catch up. It's outside the Bollinger Bands. So I'm not expecting a massive move day in Asia today by any stretch of the imagination. So anyway, so that's dollar yen. But overall, you'd guess most people are thinking it's going to head back to 125. Now let's see if we have a look if I can find it. The Aussie market SPI 200. It's held 51.24. I think 51.50 on the physical. Watch 51.50 on the physical. 51.50 on the physical goes, then you could see the Aussie in strife. But it held down towards those levels last week. Lots and lots of moves today, guys. Have a look at your charts. They're working well again. They give you guidelines and guidance on where things are going. So I've probably taken up enough of your day today. Have a great day. Look out for me on Twitter. You'll see me tweeting a lot more from the Greg McKenna Trading Club. I'm also tweeting from the Axie Trader handle. So I'd recommend you follow that one. And I'll be much more active, I think, on Twitter and talking about markets on a day-to-day basis. I'm still committed to writing for Business Insider. That's one of the most fun things I've ever done in my career. But the combination of Axie and Business Insider lets me concentrate much more on markets, which is what I want to do. And I'll be launching a little family and friends fund, probably in the next 6 months or so. But that's it from me. You can find me on Twitter at Gregory McKenna. You can also find me via the Axie Trader handle these days. gregmckenna.com.au. I don't know what the link is to axietrader.com, but it's there for the pages that I'll be writing. So keep an eye on that. And if you've got any questions, feel free to DM me on the Trading Club rather than the BI one. But that's at FX_global is the Trading Club. That's probably if you're a trader and you want to watch markets, that's probably the best place to get me. If you're more of an all-rounder who's interested in lots of other things, including me bashing up the banks, which I want to do, the Gregory McKenna Business Insider handle is probably the best one. Anyway, have a great day today. It's looking like an important and big week. Chinese CPI data, US retail sales later. But don't get spooked and don't panic. This is a market to look at your levels and watch where they are. So anyway, have a great day, and I'll see you tomorrow morning. Bye for now.